3 weeks ago, oil markets dropped $13 in a single session because President Trump said the Iran war was very complete. Brent crude was at $91. Today it is at $113, a 50% surge in 1 month, the steepest monthly gain since the 1990 Gulf War. The market has stopped listening to the president's Sunday evening peace signals. What changed is not the rhetoric. What changed is the physical reality. The Strait of Hormuz, through which 20% of the world's oil transited before February 28, now sees fewer than 5 vessels per day, down from over 100. That bottleneck is not a negotiating tactic. It is a supply cut that no amount of strategic reserve releases can fully offset. The International Energy Agency has already drawn down 400 million barrels, and prices kept climbing. Meanwhile, Iran-backed Houthi rebels entered the war over the weekend, launching missiles and drones toward Israel. The Pentagon is reportedly preparing weeks of ground operations inside Iran. On Monday morning, Trump threatened to obliterate Iran's power plants, oil wells, and Karg Island, the export hub for 90% of Iranian crude. Saudi Arabia's east-west pipeline is now running at full capacity of 7 million barrels a day to bypass the Strait, but that ceiling will not hold if the Red Sea corridor also comes under sustained Houthi attack. Societe Generale is already forecasting a base case of $125 Brent in April, with credible spikes toward $150 if the Bab el-Mandeb Strait closes. The national average gas price reached $3.99 per gallon on Monday, up from $2.98 in February. That $1 move translates to roughly $35 less in monthly disposable income per household, before accounting for the pass-through into groceries, shipping, and packaging costs. The oil price is not just a consumer story, it is a central bank trap. Jerome Powell spoke at Harvard on Monday, and the message was precise and uncomfortable. The Fed has not lost sight of its 2% inflation target, but its tools have no meaningful effect on supply shocks. That sentence matters, because it closes the door the bond market had been leaning on. For the past several weeks, traders had been pricing in at least one rate cut this year, arguing that a war-driven slowdown would eventually force the Fed's hand. After Powell's remarks, that bet reversed. Bond traders are now scaling back cut expectations because the arithmetic has changed. Inflation had been flatlined near 3% for 2 years. With oil at $113 and trending toward $125, Citi's chief macro strategist told Bloomberg the coming months could see inflation, quote, significantly higher. A Fed that cuts rates into accelerating energy-driven inflation risks credibility damage it spent years rebuilding. A Fed that holds rates while consumer spending contracts risks being blamed for a recession it did not cause. Dallas Fed manufacturing data released Monday showed continued contraction in March. The 10-year Treasury yield had already risen last week, after 2 consecutive bond auctions drew weak demand. Investors demanding a higher premium to hold duration as the inflation outlook deteriorated. Powell's wait-and-see framing was not a pivot toward dovishness. It was a signal that the Fed will not rescue markets from this. The equity market has begun to price that in. The S&P 500 has now declined far enough that even bearish Wall Street price targets look optimistic. And at least one research firm published a note flagging 3 ominous signs of further downside. The war's second-order effects are now visible in specific equities, and the pattern reveals where institutional capital is being repositioned. Alcoa surged 11% on Monday after Iran claimed attacks on aluminum production facilities in the region. That move is not speculative. It follows a direct causal line. Disrupted Middle East industrial capacity, combined with higher energy input costs globally, creates a supply squeeze in aluminum that benefits producers outside the conflict zone. Alcoa is one of them. Energy stocks broadly are benefiting from the same dynamic. Petrobras, the Brazilian state oil company, is up 78% year-to-date, as buyers seek non-Gulf supply alternatives. Goldman Sachs raised its price target, and Morgan Stanley followed. Capital is not fleeing risk wholesale, it is rotating out of rate-sensitive growth and into commodity producers and hard asset plays. The SpaceX IPO adds another dimension. E-Trade is reportedly in advanced talks to lead retail distribution of a SpaceX share offering at an implied valuation of $1.75 trillion, with Robinhood and SoFi competing for secondary roles. In a week when the broader market is under pressure, an IPO of that scale draws liquidity from elsewhere and tests retail appetite for long-duration growth stories at a moment of maximum macro uncertainty. The forward picture depends on two variables: whether Houthi forces expand their Red Sea campaign, and whether Trump's threat to Karg Island translates into action. If Karg is struck and Iranian oil exports are severed entirely, Societe Generale's $150 scenario is not a tail risk, it becomes the base case. In that environment, the Fed's wait-and-see stance becomes untenable in both directions. The one concrete benchmark to watch is the next weekly U.S. Energy Information Administration inventory report, and whether the IEA signals a second emergency reserve release. If neither arrives, the market will price the $125 base case before the end of the week.